Hello there. This is Bruce at Fleet Capital Management. It's Friday afternoon, the 24th day of July, 2026. Markets closed. Kind of a difficult week, but I'm very happy with what I have been seeing from my investment model, and I want to show that to you today. So we always start by saying that the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. You know I'm always available. Bruce at Fleet Capital Management. So I created this portfolio, this model, if you will, and I'm calling it the ETF Core Portfolio. And I've talked to you a little bit about it. I want to talk to you about it today in a little bit different twist because many times people see performance numbers, and this is the actual performance uh, over the last 12 months. It's up 35%, and the S&P is up 16%, so just slightly more than double. And a lot of investors just sort of lock onto that and forget everything else. Well, I want to show you everything else. Um, there will be down days. There will be down months. Our objective, this portfolio's objective, is to not be down as much as the markets are down when the markets are down, if that makes sense. And we're going to talk about that. So, based on some of the data that we have on this, it says 76% of the months were positive. That's great. I want you to focus on a quarter of the months were negative. That's really important to understand that we're going to have negative months. We have some negative months here. March of 2026, this portfolio lost 3.6%. March of 2025, it was down 1.1%. April of 2025, it was down 1.58%. July is not closed yet, but it's down 0.67%. So there will be months where it has negative returns. That's okay because what we want, and what I'm going to show you in just a couple of slides, is we want to be down less than the market. On a daily basis, this portfolio closed higher 61% of the trading days. What does that mean? About 40% of the trading days, it closed lower. So we're just talking about up versus down. But I really want you to understand that even great portfolios are down some days, some weeks, some months. Yesterday was the 23rd, and the S&P was down 1.2, and the Nasdaq was down somewhere around 1.9. So blended, I like to say, because I like to blend them because in reality we're investing in both. Let's just call it, it was down 1.5% blended. Our portfolio was down 0.61. So the portfolio was down, but it was down dramatically less than the S&P and the Nasdaq. That's the point. That's what I want to see on down days, and on up days, I want to see our portfolio do at least as well as the S&P, but what I have been seeing, it is been doing better on the upside as well. Here's another way to look at this. Drawdowns. Drawdowns happen. So this is over the last year, and the green line is this ETF core portfolio, and the lighter line is the S&P, and that's consistent throughout all of the charts I show you. Last March, we had this really big drawdown in the S&P 500, and this ETF core portfolio did go down, but it didn't go down near as much. Sometimes it does, many times it doesn't. Here was a pullback in the S&P, and my portfolio, the core portfolio, really didn't go down almost at all. When you even all of this out, you will see that the ETF portfolio average drawdown is negative 1.21%, and the S&P 500 average drawdown is negative 10.7%. Do you see that? That's an incredible disparity. That's how I designed this portfolio. And I'll show you why I did that in just a second. But so far, it's been doing exactly what it's supposed to do. And I'm really happy with that. So, market drawdown periods. I was explaining this to someone yesterday. There are two different types of catalysts that make the market go down. One is event driven, the other is systemic changes. So let's talk about event driven because this is by far the most common. Event driven. War in Iran starts. That's an event. Tariffs are implemented. That's an event. I'm trying to think. It could be any one of a number of things, but if they are events that push the market down hard, our plan is to ride through those short-term drawdowns, even though they might be somewhat painful. Our goal with this portfolio is to ride them out. Now, that's different than systemic economic changes. If I see like at the end of 2021 and very early 2022, it looked like there was a pretty strong probability for a bear market. If that happens, then I will put stops on each of these investments. And if we go into a protracted downturn in the market, we'll get stopped out. We'll be in cash, excuse me, we'll be in cash, and we'll go back in. There are three different ways, because this is very hard to predict, but there are three different ways of anticipating a pretty strong drawdown. One is the technical indicator that I use, that I created, which is the 10-week moving average crossing below the 20-week moving average. That is my bear market avoidance indicator. If that happens, alarm bells go off and I start doing an enormous amount of research to try to see if this could be a longer term systemic change. Um, I also, the best analyst I have ever met in 40 years at calling those is Tom Bowley. So when I see my indicators cross, I immediately get on Tom's site. I start reading all of his recent papers, and if he's getting as worried as I am, then it's confirming my feeling. A third indicator is if it looks like we're going into a fairly consistent period of rising interest rates, or a strong inflationary environment. We have not been in a strong inflationary environment. We haven't seen a lot of rises in interest rates recently. We have been in an inflationary environment, but it's been really coupled with a weaker job market, so it's been kind of stagflation. But I hope this makes sense. There are a lot of event-driven pullbacks in the market. We're going to ride through those. But if we see something major, we're not just going to sit and stand by. Okay? Hopefully that makes sense. Portfolio groups. I want to cover this a little bit more. Let me try to move this out of the way, because there's been some confusion around this. Group 1 and 2 will both utilize the same core ETF portfolio. That's the one I've been showing you. And whenever I talk in my daily emails about our ETF portfolio, it's the same one for Group 1 and 2. Here's the difference. Group 1 will invest approximately, so let's just call it between 80 and 85% will be allocated to this ETF portfolio that I've built, and somewhere between 15 and 20% will be allocated to stocks or special opportunities. What's an example of a special opportunity? Bitcoin, for those of you who want to be in that. It could be semiconductors. It could be it could be gold. It could be silver. It could be anything that is a fast mover that looks like it's getting ready to break out. So group one, 80 to 85% allocated to the portfolio model, which I call it, and 15 to 20% to stocks and special opportunities. Group two is almost all invested in the ETF model. I will generally leave about 5% in cash and use 3% of that for special opportunities, but the majority of Group 2 is invested in the model. Group 3. Group 3 has actually two choices. You can choose a 100% downside protected portfolio, or you can choose a significant downside protected portfolio. The option B is not 100% downside protected. Over a year, will there be any losses? Probably not. Could there be? Yes, small. In the 100%, I am using securities that mature, and they're always a year or less, with absolutely no downside risk. That portfolio will generate a lower rate of return than this portfolio, which is the significantly downside protected portfolio. I hope that makes sense. So if you have chosen group three, I'll reach out to you, but you could just shoot me an email and let me know what your preference is. Understanding that the B, the significant downside protection, will almost always generate a higher rate of return year over year than the 100% downside protected. Now, with that said, my goal, my objective, I should say, for the 100% downside protected is to get you a return that is greater than you could get in CDs, in treasuries, in anything like that that is also 100% downside protected. I've seen these securities generate 7% returns in a year, maybe even 8% in a year. Now, on the significant downside protection, I'm trying to get a higher rate of return than that. So that's why there's a little bit of downside in there, but not a lot. So I hope this makes sense. Once again, if you have already reached out and you're in group three, let me know which you prefer, and I'll reach out to you as well. So I hope this really clarifies what we're doing. So in my emails, when I say our ETF model is doing really well, it did better on the upside, it did better on the downside, this is what I'm talking about, and it's in both group one and two portfolios. Okay? Again, just let me know if you have any questions about this. We always talk about the market, and the market is the most important thing that we need to understand what's happening with it. We've been range bound in the S&P. Someone said to me the other day, it's been weeks, it's been months. I'm not seeing my portfolio change because the market has just been sitting in this range. It hasn't been doing much. It's been consolidating. And when the volume, the on balance volume is pointing down, there are not a lot of buyers in the market. There might be more sellers in the market. It's a cautionary time. Remember, back on July 6th, Trump declared that the ceasefire with Iran was over. And, it's just been insanity since then. And now, uh, pretty good rumor has it on good authority that the U.S. may be planning, I hate to say the U.S., that Trump administration may be planning a significant escalation in this totally unnecessary war. You've got to remember, they didn't have nuclear weapons. We had a treaty. The inspectors were going into Iran. The Strait of Hormuz was widely open to traffic. Nothing was a problem. And then Israel and America attacked them. So this is a war of choice. This is not a war of necessity. And when we have all of this uncertainty, you're going to see the VIX bounce between bullish and cautious, and you're going to see volume drying up because we don't know what's happening. So that's why we are currently in a pullback. The 20-day is over the 8-day. Let me show you all of this on the chart. So on the daily chart, which is over here, and I'm on the SPX, the 20-day, which is that green line, is just about ready to touch the 50-day, but it hasn't yet. But the 8-day, the white, is below the green. That is a pullback. The 20 is over the 8, and they are both over the 50. Here we are. The 20 is over the 8, and they're both, well, the 20 is over the 50. Okay, so we're in a pullback, but if this negativity continues next week and that green line, which is the 20, crosses below the 50, then we're in a correction. And those happen, um, but they're not good. We don't like them, but they do tend to happen yeah, I'll say 2 times a year, 2 to 3 times a year. Pullbacks tend to happen 5 to 6 times, 7 times a year. That's pretty common. But the other starts to get us worried. But that's why we're in this portfolio that is even doing well when the market is falling. Okay. So that is the daily. On the weekly, and we're clearly, here's the weekly on the right, we're inside of linear regression. We had a short term but pretty big run up. And then from May until now, we've done nothing. The market has done nothing but go sideways. But our bear market avoidance indicators, which is the green line, the 10-week, is over the 20-week, significantly over. I would argue maybe that's too wide, and maybe we do need a little bit more of a pullback before we continue to run up. But we're also in the summer months. As we approach the end of July and go into August, September, and the very beginning of October, that is historically a very weak time for the markets. People go on vacations and volume dries up. But as long as we are outperforming, I'm happy. And let's go over to this is the platform I use for to do research on the portfolio that I built. So here is my ETF portfolio, okay? And it is very well diversified in that I have growth and value. Here's value. Here's value. I have US and international. Here's international dividend. Here's global equities. I've got convertible bonds in there. I've got two different types of momentum strategies in there. SPMO, I've been in for a long time, love it. That portfolio inside SPMO gets rebalanced twice a year. In the last year, Fidelity has put out a newer momentum platform that rebalances once a month. So these are both great investments based on momentum. They just do the internal workings differently. Okay, if I come down here, you've seen this chart, you can see and green is the portfolio, gold is the S&P. It pretty dramatically outperforms. So we're happy about that. This is what I showed you from yesterday. This will not update for today until overnight. That's why I'm talking about yesterday. But yesterday, just the S&P was down 1.2. The S&P and the Nasdaq combined were down around 1.6, and we were down 0.6. That's extraordinary. Even just looking at the S&P, we were down half as much as the S&P was down. That's what I'm talking about. That is great. And that is by design. And this is what's going to allow us to ride through those event-driven, Trump-driven hiccups in the market. But when we go out longer term, we go out 6 months, here's the S&P up 7, here's our portfolio up 17, year to date up 8, up 21 and a half, 1 year, S&P up 16 and a half, our portfolio up 34. So it's almost 2 to 1. In many cases, about 2 to 1. And okay, let me show you a couple of other things. I showed you the monthly returns. This beta means that our portfolio is about 17% less volatile than the S&P 500. And based on that reduced volatility, the portfolio alpha, which is excess return, this is how we judge managers, is extraordinary. 12.7 is extraordinary. So all of the metrics on this portfolio, especially down here, Here are five of the most widely used institutional grade risk metrics. And then there's an overall rank here. And no matter how you slice and dice this portfolio, this is exactly what institutions use, the big ones. It puts us in the top 95% of portfolios. It means strong relative to risk returns. And then it says this is exactly what professional investors look for. This is well suited for investors who want to maximize return per unit of risk. And it breaks down all the risk metrics even more. And this is updated every single day. So I just want you to know a lot of work has gone into this. Both group one and two are using this. This is the ETF portfolio. The only difference is group one is going to carve out 15 to 20% of their portfolio for stocks, special situations, things like that, and much less so for group two. And then group three are people that just don't want to handle almost any, or they don't want to handle any downside risk. And you can make changes anytime you want. You can call me and say, I'm in group three, but let's just say we're 3 months down the road, and I'll be showing you these returns because they update every single day. Every day, these charts update every day. So I can show you at any time period what the returns have been. And maybe you're in group three, and in a few months you say, you know what, I think I would like to switch to group two. Fine. You're in group two, you want to switch to group one. Fine. You're in group one, you want to switch down to group two. Fine. You're not locked into anything. And at any time, I can, this is the last thing I'm going to say on here is I'm going to go back to this chart where here's where the S&P was kind of high. It was before this last major drawdown. And I'm going to click on that and then I'm going to drag to the bottom of that particular, whoops, drawdown. And there it is. And what this is showing is the S&P for that time frame, which was 1 month. It was February 26 to March 26. The S&P was down 8.3. Our portfolio was down 5.3. We did better than the market. And I can do that for any time frame at any time. So if you have a question, I just chose this because that was the last big drawdown. Just ask and I'll produce it for you. So there's a lot of information in here. It's a solid portfolio. It's so far doing better on the upside and the downside. And I monitor this every single day. I will make changes infrequently, but as needed. I'm consistently doing research on each and every investment. And if I find something that has better metrics, better risk adjusted performance than something in the portfolio, I'll make that switch. But hopefully not. Hopefully that I've done so much work on this. I'm actually having a hard time finding anything that's better. If you have questions, if you want to see how this works in your account, just schedule a call with me or shoot me an email and we'll go from there. If you ever have any questions about this, let me know. But I personally, I'm very excited about this. I'm continuing to work on it. I'm also continuing to work on group three accounts to see how I can get that return up a little bit more. I'm working on our stock picking to see if I can smooth that out a little bit more. So the work never ends, but this was the biggest piece I had to get done, and I am now done. Okay, for now. So that's it. If you have any questions, let me know. Enjoy your weekend. I'm always around, and I will talk to you or be back doing this early Monday morning. Bye bye.